So welcome everyone, and thank you for joining us for a conversation about global tax justice with David Bradbury, Francisco Ferreira, and Gabriel Zucman. This event is organized by the LSE Global Economic Governance Commission, a forum to encourage debate and devise policy solutions for the most important problems in global economic governance. Let me begin by briefly introducing the speakers. David Bradbury is the head of the Tax Policy and Statistics Division of the Center for Tax Policy and Administration at the Organization for Economic Cooperation and Development. David is an Australian national. He joined the OECD in 2014, where he now leads a team of economists, lawyers, and statisticians who are working on delivering high-quality economic analysis and tax policy advice. David was a key contributor to the delivery of the OECD G20 Base Erosion and Profit Shifting Project, as well as the historic two-pillar solution to address the tax challenges arising from digitalization of the economy, which was agreed by more than 135 jurisdictions. In particular, his team has been carrying out the OECD's economic analysis and impact assessment for this landmark international tax agreement. Francisco Ferreira is the Amartya Sen Professor of Inequality Studies and the Director of the International Inequalities Institute at the LSE. He's also affiliated with the Department of Social Policy. So he's an economist working on measurement, causes, and consequences of inequality and poverty, with an emphasis on developing countries and Latin America. So he's published widely in venues including the Journal of Public Economics, the Journal of Applied Econometrics, World Development, and many others. His research awards include the Richard Stone Prize in Applied Econometrics and the Kendrick Prize from the International Association for Research in Income and Wealth. Francisco is a research fellow at the IZA in Bonn and an affiliated scholar with the Stone Center on Socioeconomic Inequality at the City University of New York. Before returning to the LSE, he had a long career at the World Bank, where he co-authored a flagship report titled Inequality in Latin America, Breaking with History, which was an important reference for me when I was starting my research on the politics of taxation and inequality. He was born and raised in Sao Paulo, Brazil, and holds a PhD in economics from the LSE. And finally, Gabriel Zucman is Associate Professor of Economics and the Director of the Stone Center on Wealth and Income Inequality at the University of California, Berkeley. He received his PhD from the Paris School of Economics and taught at the LSE before joining UC Berkeley in 2015. His research focuses on the accumulation, distribution, and taxation of global wealth and analyzes the macro-distributional implications of globalization. Gabriel has been honored with multiple prizes, awards, and fellowships. So most recently, he received the 2017 Excellence Award in Global Economic Affairs from the Kiel Institute for World Economy, the 2018 Best Young French Economist Prize, the 2019 Bernasser Prize, along with a Sloan Research Fellowship, and he was named a 2021 Andrew Carnegie Fellow. In addition to numerous articles, he's the author of two highly influential books that have made an important contribution to public understanding and policy debates on taxation and inequality. The Hidden Wealth of Nations, published in 2016, quantifies the amount of the world's assets that are held in tax havens, at least $7.6 trillion, and offers an agenda for examining how countries can change the incentives for tax havens. His 2019 book with Emmanuel Saez, The Triumph of Injustice, How the Rich Dodge Taxes and How to Make Them Pay More, focuses on tax inequalities in the US and details how the country went from having one of the most progressive tax systems in history to enacting policies that benefit really only the richest of the rich. Gabriel has many innovative policy recommendations that can foster tax justice despite constraints of globalization, and I'm sure we're going to have the opportunity to hear about his suggestions today. To briefly introduce our topic, President Biden called for a global corporate minimum tax at the G7 summit in June last year. Under this proposal, multinational firms with a 3-year average adjusted book income over $1 billion would be subjected to a tax of 15%. The US proposal was followed by the OECD's 2-pillar program announced in October. So a key question for our panelists is whether these measures are enough to mitigate the race to the bottom that characterizes the global tax system, along with enhancing the ability of low and middle income countries to raise revenue and addressing other persistent problems with tax havens and illicit finance. So what additional measures might be technically promising and also politically feasible? So the speakers are going to give us an initial round of comments in reverse order of the introductions, starting with Gabriel Zucman. So Gabriel, the floor is yours for the next 10 minutes. Thanks so much.
Thank you so much, Tasha, and thank you for being here and for having me. I'm very much looking forward to the discussion and your questions. Let me start by sharing my screen as I prepared some introductory remarks. I trust that you can see the slides and you can hear me well. And the starting point of my remarks is that our tax systems, to a large extent, are what you could call the brain children of the 1950s. If you look globally, and it's true also in most countries, the value-added tax and payroll taxes account for more than half of tax revenues. The VAT was invented, first experimented in France in the 1950s, and it's one of those great French exports. You know, it caught fire, it was generalized pretty much all over the world, starting in the 1960s. Payroll taxes are a bit older, but it's only after World War II that they became quantitatively significant in the context of the creation of the modern welfare state, social security systems, retirement, and health in particular. Now, all of that made a lot of sense in the post-World War II European context. Having a big flat tax on consumption, which is what the VAT is, made sense in a context when capital was scarce, you know, after the world wars. And so policymakers wanted to encourage saving, and so it made sense to say, okay, we're going to generate a lot of revenue by just taxing consumption and exempting saving. Funding the welfare state primarily by having big flat taxes on wages, which is what payroll taxes are, also, you know, made sense in a context when after the world wars, the labor share was relatively high and wages were growing relatively fast. And having flat rates, you know, was okay in a context when inequality was at a relatively low level, at the historical nadir. In fact, you know, after World War II, it's when, you know, top income shares and top wealth shares reach their historical minimum in many countries. Now, today's context is really the opposite of the 1950s. You know, capital is rising back. You know, the ratio of wealth to GDP was around 200% in many countries in the 50s, 60s. Now it's around 600%. So just wealth in relation to output is just 3 times larger than it used to be half a century ago. The labor share is falling and the capital share is rising. And income and wealth inequality are rising globally, particularly fast in countries like the US, China, or India. So we need to invent 21st century tax systems that are going to be adapted to the inequality challenges of today. Now, the problem is that there's a widespread view that progressive and capital taxation are doomed in a globalized world. There is this view that tax competition, tax avoidance, tax evasion mean that mobile factors of production like capital or highly skilled workers cannot be taxed much because otherwise they move to low tax places. The problem with this view is that it's not quite true. Tax competition and tax evasion are not laws of nature. They are policy choices. Of course, not choices that were very transparently and democratically debated, but choices nonetheless. And other choices are possible. The current form of globalization that we have, that's characterized largely by unfettered tax competition, is just one among many possible forms of globalization. And indeed, there has the proof of this is that there has already been some progress, some changes in the way that we regulate or choose not to regulate to a large extent globalization and tax competition. There has been some progress over the last decades. Most importantly, there's been the creation of an international exchange of bank information, since 2017, 2018. And there is now the prospect for an international agreement on a 15% minimum corporate income tax, what is known as the second pillar of the OECD two-pillar solution. So what we're going to discuss today is whether these policies are up to the challenges, and if not, what else is needed. Let me make it very clear from the beginning what is my perspective on those questions. I think these are very important steps forward and very important achievements. At the same time, I think they are very far from what we need to achieve and where we need to go. To provide some context, according to the estimates that we have, for instance, on this website, missingprofits.world, close to 40% of multinational profits each year are shifted to tax havens. Multinational profits are profits made by multinational companies outside of the country where they are headquartered. Think of the profits made by Apple outside of the US or BMW outside of Germany. We estimate and we provide numbers and the complete methodology on that website, numbers on a country-by-country basis, that globally almost 40% of these multinational profits are shifted to low tax countries where these profits are taxed typically at effective rates around 5%. Okay, so what about the OECD agreement, and in particular the second pillar, this 15% minimum corporate income tax? Why is it a progress and why is it far from sufficient? Initially, to summarize my thoughts on this, initially it was presented as a way to end the race to the bottom with corporate taxation, but it must be said very clearly that Pillar 2, in the way that it currently is designed and likely to be implemented if we reach an agreement, in fact, is not going to end the race to the bottom, and in fact accepts and even embraces tax competition. Why is that the case? You have to understand the way it works. So it's a 15% minimum tax on country-by-country profits, which is great because it means that, for instance, if a company books income in Bermuda or in the Cayman Islands, those profits that used to be subject to no tax at all because the corporate tax rate is 0 in those places, now are going to be subject to a minimum tax of 15%, which is real progress. But, and we've not talked enough about that, but this is very important. This is, somewhat technical, and yet this is really the core philosophical and economic problem with this agreement. There is a big exemption for, quote unquote substance, meaning that a company can exclude from the base of the minimum tax an amount of profit which initially is going to be equal to 8% of the value of their capital stock plus 10% of their payroll. So companies in Bermuda and Cayman Islands, typically don't have capital and employ very few workers there, and so they won't be able to exclude much profit, and so the profits in those places will be subject to a 15% minimum tax. But multinational companies in Ireland, in Singapore, in Luxembourg, in relatively low tax countries where there is actual substance, there is actual production, there is capital, there is workers employed, those firms will be able to exclude a big part of their profit from the minimum tax. In fact, some firms might be able to exclude all their profits from the minimum tax, meaning that these firms will still be able to pay perhaps as little as 0% in effective taxes in those tax havens if they have sufficient production in those countries. So you have to understand the underlying philosophy of the agreement. The underlying philosophy is that profit shifting to places where there is no substance, tax competition that's artificial, shifting profits to places like Bermuda is not okay, and there should be some floor to effective tax rates in those countries, 15%. But tax competition on real, production, real tax competition, factories moving to low tax places, workers moving to low tax places, production, headquarters moving to low tax places, all of that is okay, and even rates of 0% are okay as long as there is actual production taking place in low tax countries. I think this is pretty dangerous because this is going to increase incentives for firms to actually move production and relativity to low tax places. It doesn't address the race to the bottom. It might well exacerbate the race to the bottom. Okay, so let me conclude by saying that we need new instruments, new forms of cooperation, and new institutions to address the challenges of the 21st century. Number one, more ambitious minimum taxes with no carve-outs, no exemptions for substance, and also higher rates. In most high-income countries, the tax to GDP ratio is around 40, 50%. So it's very weird to say that for multinational companies, the main winners from globalization, the economic actors that have most benefited from economic transformations of the last decades, that for these actors, it's okay to pay only 15%. That's not super easy to explain to people and super easy to accept by working class and middle class individuals who pay 30, 40, 50% of their income in taxes when you add up the VAT, payroll taxes, and other taxes. Number two, the way to get there to more ambitious minimum taxes is by escaping the straitjacket of unanimity. We don't need agreements that please everybody. We can make progress with unilateral or multilateral agreements. And last, in the current agreements that we have, I would say that I think it's fair to say that a number of tax havens are given much more weight and have much more influence on the outcome than countries like Brazil or India or South Africa. And that's not okay. We need, as a global community, to take the interests of developing countries much more seriously. Thanks a lot, and I look forward to the conversation.
Thank you so much, Gabriel. So Francisco Ferreira, the floor is now yours for 10 minutes.
Thanks very much, Tasha, and thanks to Gabriel for that very clear and lucid presentation. I'm actually not a tax expert, so I'm here on false pretenses, primarily to learn from Gabriel and David. So let me just make two quick points in complement to what Gabriel has said. The first is to link the tax side to the spending side. I think there are fundamentally two reasons. There may be more, but fundamentally two reasons to emphasize tax on the rich, be it through the corporate taxation or through private income taxation. And those two reasons are, first of all, to address the concentration of political power that comes from rising inequality in wealth, right? So if we have these oligarchies arising as we have in the United States, as we have in Russia, as we have had for a long time in Brazil and South Africa, then the concentration of income that generates is accompanied by a concentration of political power that leads to a threat to democracy. And we've seen this, we see this increasingly in the United States, but we've seen it in many countries where the excessive power in the hands of very rich people can lead to sort of policy decisions and institutional design that are not optimal and not in the interests of most people. So that's a reason. But the second reason is perhaps even more important, and that is we tax people and we try to tax them progressively in order to finance the kinds of policies that are needed to level the playing field and to promote better opportunities and better lives for the poor. So whilst I welcome the recent shift that we have had, where Gabriel has been very active, and so have Thomas Piketty and Emmanuel Sais and that whole group, there's been a huge shift towards looking at the top, and I think that's very important. But what I want to say is that we really shouldn't forget that those revenues that we raise with those taxes should then be very well spent in promoting policies that are needed to raise the playing field. The inequalities at the bottom, even in rich countries like the US and the UK, but even more so in poor countries, are enormous in terms of people's lack of access to education, differences in quality of education, differences in quality of healthcare. There's all this work on early childhood development that shows that kids reach the age of 5 or 6 or 7 very different vocabularies depending on the homes they grew up in, the families they were born into. So there are some very unfair and very substantial inequalities that are present in the world, and that tend to perpetuate themselves and to reproduce across generations very easily because, and I think this is important, families, family is a fundamental institution of our societies. And, we tend to think that everything about family is good, but families act as major transmitters of inequality. We all want to invest massively in our children, and rich, educated people are able to do that better than other people. Families transmit genes, families transmit human capital every day as we interact with our children. Families choose neighborhoods, and neighborhoods matter. Families put people in the schools that they can afford or can live near to, and that matters. Matters through the teachers that vary across the schools, and also through the students' peers, the sorting of people into this. Families transmit norms and social beliefs, which sometimes are reinforcing of inequalities across social groups. And that's not even, I haven't even gotten to the transmission of physical and financial wealth through bequests and inheritance, which also matters a great deal. The point of all that is to say that because families, through the sorts of things that we all want to do for our children, are intrinsically inequality perpetuating, the state needs to respond. The state needs to level the playing field. It won't level by itself. And so, if families act as I have described, then ideally we'd like to see the schools that poor children go to be better than the schools that rich people go to, right? Because it needs to offset, not even equality of access won't do. We need to promote investment in education and health and other services so that those who come from disadvantaged backgrounds actually have access to better services that enable them to have a chance to prosper. And that's very demanding. So my sort of second point related to that is that I think we have seen too few experiments in more radical ways of promoting opportunity around the world. We certainly have seen lots of policy experimentation around the world. We have seen it in rich countries, various different labor market activation policies, various different kinds of tax credits. We have seen them in developing countries with early childhood development interventions, with conditional cash transfers and so on. But mostly in the big picture of this kind of self-reproducing inequality across generations, those have not really changed things, changed the playing field. There have been some bigger experiments, arguably moving to opportunity in the United States, which promoted the ability for people to move. But that's also, restricted to just moving across neighborhoods. Perhaps the best example actually is from a developing country or from a set of developing countries. Our policy is called Targeting the Ultra Poor, which started in Bangladesh with BRAC and were tried in a number of other countries. And there were transfers of assets, often livestock, but assets and income and advice and training for long periods. And some work, including by colleagues of ours at LSE, like Oriana Bandiera and Robin Burgess and others, but also by Abhijit Banerjee and many other people, show that those made a substantial difference in how rural women at the very bottom of the distribution in these countries managed to move up, change their occupations from being maids to being livestock farmers and husbandry. And in doing so, we're able to sustain an increase. That was easier to do in poorer countries because the amounts of money are not so large. But I think we need experimentation around these kinds of big investments in the poor. And the kinds of tax revenues that we ought to be getting from increases in taxes like the corporation taxes and so on should be directed to that kind of thing. We need a bigger effort, not only on the taxation side, where we certainly need effort. And the agenda that Gabriel and his co-authors have set is hugely important. But we also need that bigger effort and bigger thinking on the spending side. Now, the final point I want to make is related to, in the sort of 2 minutes that I have, is related to Gabriel's last point about developing countries. And that is to say that it strikes me that in the conversation about the global tax system, which is what this is about, it's really important to not forget that I think we have a unique opportunity of addressing perhaps the two biggest challenges that the world faces today, which are inequality and climate change, through a well-designed carbon tax system. The heavy carbon users are in richer countries, and poorer countries are not heavy carbon users. So a large carbon tax, the revenues of which were shared internationally and could therefore be redistributed, would be an amazing way of dealing with both the climate crisis and inequality. Now, you say that this is deeply unrealistic because the political economic conditions for that are not there. But again, as Gabriel said, these are policy choices. We could have international institutions that could be set up to look at the ways of redistributing the revenues from a global carbon tax. Perhaps, conditional cash transfers and unconditional cash transfers were used in developing countries. We could have conditional and unconditional carbon transfers, where you could say to a developing country, here's some unconditional amount, but the rest will be conditional on your rate of deforestation. And that would get people in Brazil and Indonesia and the DRC paying a lot of attention to what they're doing. So I think there is scope for at least a bigger discussion on how to integrate the issues of climate change and inequality through a discussion on carbon taxes. So let me end there. Thanks very much.
Thank you so much, Francisco. Let us go now to David Bradbury.
Thanks very much, Tasha, and great to join you all. Good to be with you, Gabriel and Francisco. Look, I agree with many of the things that have been said. I certainly agree with Gabriel's perspective on the progress that has been made in terms of automatic exchange of information, which allows governments now to have greater visibility over the capital income that their residents might be generating anywhere in the globe. And all of a sudden, governments have the ability to tax that in a way that they previously didn't. The two-pillar solution, of which I'll speak a little more about shortly, clearly there's still ongoing work in progress there, but this is a significant, really meaningful step forward. And Francisco, in terms of his identification of the importance of tackling inequality and the importance of tax as an instrument for redistribution, I agree with that perspective. I think it's equally as important how the money is spent. But I will focus my comments on the international corporate tax system, of which the two-pillar solution is very much directed towards. And to offer a slightly different perspective, I come to this debate before I came to the OECD. I was a member of Parliament in Australia. I was a minister in the Australian government. And the reason I ended up at the OECD was a thing called an election. And I not only lost government, but I lost my seat in Parliament. So I have a really deep appreciation of the importance of democratic legitimacy in everything that we do. And I think it is important when we're thinking about international corporate taxation that we never lose sight of the fact that, within that loose thing that we might describe as the international corporate tax system, there are a collection of countries and they all exercise sovereign taxing power. And most of them, not all of them, but most of them are subject to some degree of democratic accountability. So, this is a complex set of arrangements, and there have been many good people try to do very ambitious things that have not been able to get things over the line. From my perspective, that shouldn't limit our ambition, but sometimes it might temper the way in which we seek to get things done. Because, I often think that seeking perfection, you never want to allow perfection to be the enemy of profound and significant progress. And I think on many of the things that have been achieved, that is what we're looking at. In terms of the two-pillar solution, we haven't talked a lot about the first pillar, but I think it's important because this is a highly digitalizing economy that we're in. We've all seen that, we've experienced that most of our lives, but the pandemic has really shown us how that's accelerated. And with that digitalization has come a new economy. There's come these intangible assets that are generating a huge amount of wealth. And the truth is that in that highly digitalized economy, that the system that we have today that was largely developed about 100 years ago it is incapable of responding to some of those changes. And that's what we're trying to reform. And Pillar 1 is about recognising that you don't need to have a physical presence. A firm doesn't have to have a physical presence in a jurisdiction for that country to have a taxing right over the profits that might be referable to activity in their jurisdiction. And we are changing that. Pillar 1 will change that for the first time. And as someone who studied taxation a few years ago now at university, if you told me that we would be moving to a system where, firstly, you dealt with a corporate group on a consolidated basis, not on an entity by entity basis, but you also told me that a country would not need a physical presence of that firm to tax its profits, then I would have thought that that was something incredibly ambitious and probably not achievable. Yet that's the reality of where the international discussion is today. And then in addition to that, we have the global minimum effective tax. And I think it is important to recognise that, 15%, often there are suggestions that it's insufficient, it should be a higher amount. But a 15% effective tax rate is significant. And I take on board the comments that Gabriel has made about the substance-based carve-out. But if you look at the numbers and you look at the ratio of profitability in many of the countries that Gabriel was referring to, well, firstly, there was an acknowledgement that the tax havens are basically going to be knocked out of action here. And 40%, one of the estimates there, 40% of profits being shifted into tax havens. Well, tax havens, they are not going to benefit from a substance-based carve-out because they don't have substance. But even those other jurisdictions that might have been mentioned, we're talking about essentially assets and payroll. So a very big chunk of the modern digitalised economy is being generated, profits are being generated by intangible assets that get absolutely no recognition under that formula, which is focused on essentially an asset and payroll type of assessment. So that is significant. And when you think about some of the countries that you might say, well, they'll just add a little bit more substance, in order to get the benefit of that substance-based carve-out, to be paying no tax with a minimum effective rate of 15%, gee, they're going to have to shift a hell of a lot of substance into those jurisdictions, or they're going to have to generate a lot less profit than they currently are even, because the ratio between the two is such that with a very modest 10 and 8% moving to 5% substance-based carve-out, it's actually not going to move the dial in terms of eliminating many of those firms that will be subject to the minimum effective tax rate. So I really encourage you all to look at it in terms of some of the analysis that is beginning to be shared and beginning to be released. And at the OECD, we hope to be putting some more out in the not too distant future that will inform and support that debate even more. In terms of developing countries, look, I think that one of the things that we are very proud of at the OECD is, yes, the OECD traditionally has been a group of high-income countries. We, through our tax work, have developed a completely independent process, the inclusive framework on base erosion and profit shifting. We have over 140 jurisdictions that come together on an equal footing, and they have been contributing to the discussions that have led to this outcome. And I can tell you that there are many details, many elements, many design features of the two pillars that are only there because of the advocacy of developing countries. There are many. I could look at the nexus threshold. I could look at the subject to tax rule. I could look at in fact, even with the substance-based carve-out, that is something that some developing countries have strongly argued for as well. In Pillar 1, I could talk about the extractives carve-out. There's a whole range of these things where developing countries, even the rates, the 15%, there were some countries that wanted a lower rate than that. And there was collective pressure, much of that being led by many developing countries that saw 15% become that landing point. So, I think that is an important part of the ongoing discussion. And one of the things that I don't agree with that Gabriel has said is about the unilateral measures and supporting unilateral measures. Because, look, one of the things that we know about profit shifting is one of the significant drivers of profit shifting is tax differentials between jurisdictions. If I can be taxed at a lower rate in one jurisdiction versus another, then I'll seek to shift my activity or my profit in whatever way I can into the lower tax jurisdiction. Now, one of the great advantages of a minimum effective tax rate is that it doesn't matter where you shift, you're going to be subject to that minimum effective tax rate. And I actually think that that's what is really one of the breakthrough moments in this debate, is that we can have an argument about whether 15% is low enough. We can have an argument about how much profit we think a substance-based carve-out might eliminate from that equation. But at the end of the day, a minimum effective tax rate of 15% wherever you go, that is going to have some profound implications. I saw UNCTAD recently released a report where they basically said that this could be quite significant in terms of the impact that it will have on investment, for example, because there's a lot of profit out there that's currently not being taxed at that level. And look, for developing countries, I think this is going to be a game changer. If you're a developing country that has big multinational come to town that says, boy, have we got a deal for you. We want to open up a factory in your jurisdiction, but, guess what? If you don't give us a tax holiday for the next 20 years, then we'll go to the country next door who will give that to us. Now, all of a sudden, that developing country that has probably felt that they have zero bargaining power to engage in that type of negotiation, that developing country is able to say, you know what, you're going to be taxed 15%, whether you locate that establishment here or in the country next door. Now, even if they only want to take the 15%, that's 15% more than is currently being collected if there's a tax holiday in place. And, this is about taking away some of that competition that has led to these really wasteful and inefficient tax incentives or tax holidays that are being provided. And we think it will put a flaw in that tax competition. Will it eliminate tax competition completely? No. Can you ever do that? Maybe not. Like in the absence of one world government, if you have independent countries that are sovereign on tax matters and they're accountable to their constituencies, is that possible? Is it even possible? How would that be possible? But notwithstanding all of that, I think it's remarkable that you could get more than 135, 137 jurisdictions come together and say, we're going to agree to put a floor. At the moment, the floor is not 0%. You might think that the floor is 0%, but it's not even 0% because you can offer tax subsidies, tax expenditures to companies to operate in your jurisdiction. It could be less than 0. But what we're talking about is a minimum effective rate of 15%. Now, what's the significance of that in terms of the broader discussion around tax policy? I think it's this, that when you think of the overall tax mix, across most OECD countries, the corporate tax only accounts for about 10% of total taxes. In developing countries, it's typically higher. In many advanced economies that have lots of natural resources, it's higher as well. But what I think this will do is it will guarantee a sustainable share of total taxes in countries coming from the corporate tax. And the significance of that is that it means that when governments are making decisions about other taxes, whether it be consumption taxes, property taxes, taxes on labour, they will be able to make those decisions in the knowledge that the corporate tax will be much more secure with a minimum effective global rate in place than it is at present. And that means less burden being shifted on others. And I think that that will be a very positive thing in the long run. Sorry for running a bit over time there.
Perfect. Thank you, David. So this is excellent. We've got a lot out on the table. We have some time for discussion among the panelists, and I think that it would make sense to hear from Gabriel a response to some of what David has put out. And if I could, I think it's great that we're starting to hear a bit about the politics and the background, at least implicitly. And I am wondering if, Gabriel, in your response, you could explain your alternative tax deficit proposal and some of the defensive measures that you proposed as a way to try to allow unilateral progress that sort of circumvents this kind of collective action problem that I think that a lot of what David was saying plays into constraints on the international kinds of agreements.
Yeah, absolutely. Yes. Let me first say that I very much agree with David that this two-pillar agreement, if it becomes reality, is a major achievement. Because just to give some perspective, there have been many agreements over the last years and decades to harmonize international taxation, but they were only about the definition of the tax base. How should we define profits? Where should profits be taxed? And they said absolutely nothing about tax rates. But tax policy, at the end of the day, that's the tax rates that really matter. Okay, because you can define perfectly well some tax base, conceptually perfect definition of profits, great allocation across countries. But at the end of the day, if it's to apply rates of 5%, 2%, 0%, it's a bit of a waste of time. So this Pillar 2 potential agreement is the first international agreement ever where, for the first time, countries say there has to be a minimum rate of 15%. So that's conceptually, that's really an important step and major progress. The main issue is that David took the example of some developing country that could that's subject to tax competition, where a multinational company could say, look, if you don't give us very low rates, then we'll go create a factory next door elsewhere. And unfortunately, that is not going to fundamentally change, right? Because factories, that's capital, and the profits that derive from those factories are not going to be subject to the minimum tax. Okay, so for instance, lots of developing countries have special economic zones with very low corporate tax rates, and fundamentally that's not going to change. The 15% corporate tax rate is not going to apply to those profits in a special economic zone, as long as there is actual production in those special economic zones. And so the logic. Let me put it differently. So at the beginning, 1 year ago, or a bit more than 1 year ago, there were very clear and strong statements by the US administration saying, look, we don't accept tax competition anymore. We want to change the rules of the game. We want to end the race to the bottom. And that was all good and great, but the reality of the type of agreement that we're discussing today is that this does not fundamentally change or undermine tax competition. It's very important to understand that with the type of agreement that's being discussed now, the current version of Pillar 2, it will still be possible and okay and deemed legitimate and acceptable for firms to have 0% effective tax rates, as long as they employ sufficiently many people in low tax countries and have sufficiently many factories in low tax countries or in special economic zones or in low tax places. As long as they have enough factories, enough workers, big enough payroll, headquarters, they will be allowed to pay as little as 0%. Okay, so there is no floor. And the underlying philosophy, the logic is that there shouldn't be a floor. It's countries should compete, and that's good. If there is actual production, and it's legitimate. And this is really this philosophy, this view that I want to question, and I think that we should question. That's the next step. So how can we question it? So what else could we do? I think David said no, we can't really get rid of tax competition with democratic governments. I disagree. I disagree with that. I think the reality is that countries can choose to collect the taxes that tax havens choose not to collect. So the fundamental problem that we have today is that some multinational companies have what you could call a tax deficit, meaning they pay much less in taxes than what they would pay if they were subject to some reasonable minimum tax rate of 15, 20, 25%. And the reason why this is the case is that because some countries say, look, if you move factories and employment and production in our territory, we'll grant you a very low tax rate of 10 effective rate of 10 or 5 of 0%. That's the reason why there is a tax deficit. Some firms pay very low tax rates. it's the choice, it's the democratic choice of those countries to offer low tax rates. Okay, other countries could make their own choice, which is to say, look, we are going to act as tax collectors of last resort. If some countries refuse to collect taxes, that's their right, that's their right. But now, if firms who benefit from those low tax rates sell products in our territory, or have some activity, and then those countries could choose to collect the taxes that tax havens choose not to collect. This is something that can be done quite easily. You don't need a fully international agreement, but essentially, the simplest version of this would be to say, if a German multinational company has a certain tax deficit, then Germany is going to collect, this full tax deficit is going to say, look, if your effective tax rate is 10%, and we, Germany, think the norm should be 20%, then we're going to collect an extra tax of 10% to arrive at an effective rate of 20%. Okay, you could have many versions of that. Let's say that you have a US multinational company that has sales in Germany. It makes 10% of its global sales in Germany. And this US multinational company has a tax deficit of $10 billion. Then Germany could say, look, you have this tax deficit, you make 10% of your sales in Germany, so we're going to collect 10% of your global tax deficit, $1 billion in taxes. Okay, so some countries are free not to tax, but other countries are free to tax. Okay, and so this is the fundamental reason where we could put an end to tax competition, as long as a number could be 1, 2, 3. You have to start somewhere. At least one country playing the role of tax collector of last resort, stepping in and saying, we are going to collect the taxes that tax havens choose not to collect.
Thank you, Gabriel. We can take a little bit more from the panel, but I'm curious if, I know you've been advocating this approach for some time. I'm curious if there are any countries that have shown interest in doing this, perhaps in Europe. I don't know about anywhere else. So, I mean, domestic politics is obviously going to be a constraint, but I'm curious if you've seen any response to this particular proposal from other countries.
Not, I think it was at some point the philosophy behind the plans, of the U.S. administration and some earlier versions of the Pillar 2 agreement. Okay, and then this has deviated from that. But if you look, for instance, at the presidential program of President Biden, there was this idea of a 21% minimum tax, not 15%, but 21%. And the idea that, if US multinationals paid less than 21%, then the US would collect the difference to arrive at 21%. Now, the type of agreement that we have is 15%, and it's not all the tax deficit that's going to be collected because of these exemptions for substance. But so what I want to say is that I think we've been quite close at some point of some concrete implementation of those ideas. And I've been a big cheerleader, for the two-pillar solution of the OECD. I think, again, it's a big progress. However, 1 year after, I was much more enthusiastic 1 year ago, and I think, the agreement that is on the verge of being hopefully agreed is a significant deterioration compared to what we could expect 1 year ago.
So perhaps I could bring David back in and ask if you'd like to respond, but also if you are on track for the second pillar to take effect in 2023. And I will also include a question from the audience here. Anthony, a LSE external alum, is interested in what the panelists think is the ideal minimum corporate tax rate. If not 15%, should it be 10%, 20%, 25%, et cetera?
Look, thanks. I guess firstly, our estimates, and we're still updating them with more recent data, but based on what was 2017 data, we estimate that Pillar 2 will raise an additional more than $150 billion in additional revenues globally each year. So it's not an insignificant amount in terms of what it means for revenues. So if 15% is too low, then it's certainly going to be capturing a lot of low tax profit at that point. Just in reaction to a couple of things that Gabriel has said. Firstly, I think some of what Gabriel just described in terms of if another country doesn't exercise its taxing right, then that country should. That is exactly the principle of how Pillar 2 works. Right, so the way Pillar 2 works, and this is the beauty of the scheme, is that if a firm is operating in a jurisdiction and it's paying less than 15% at effective rate, then that jurisdiction has the right to tax what they like. If they don't tax up to the 15%, then we say the headquarters country has the right through the income inclusion rule. And if they don't tax up to the 15%, then through the undertax payments rule, we're able to give a share of that 15% to the other jurisdictions that have some activity of the global multinational operating within their jurisdiction. So the great beauty of these interlocking rules is that you may choose to do nothing, but it's almost certain that there'll be a country out there in the chain that will. And in the end, the same amount of tax is going to be collected whether you collect it or someone else collects it. And I think domestic political pressures will mean that governments that sit back and don't collect that 15% while someone else cuts their lunch are not going to be very popular for having taken that decision. So I think it actually works quite well, but the difference is that there's an agreed minimum. And what Gabriel's talking about is you might say you want more than 15, you might want 20, and then you choose to do something. Now you can tax as a consumption destination, but like, is that really any different to a consumption tax? Now, consumption taxes are not that popular for a whole range of reasons. And, there's many arguments we could get into as to the pros and cons, but essentially it doesn't seem to me that that's all that different to a consumption tax, except with one difference. And that is that if in some way your decision to tax that activity might have something to do with the place of headquarters, which in the case of consumption need not be the case. But if you, as Gabriel was mentioning, if you're the headquarter jurisdiction and you say, if this firm is operating in some other place and it's not being taxed at a certain level, we'll tax up to that level. If you introduce those rules, then in all likelihood, if you do that alone, you're going to find that you were the country of headquarters for that multinational, because they will relocate. They won't stay there and they'll relocate to some other jurisdiction that doesn't impose that rule. And that's why it is important that you try and address these things in a multilateral way. Now, look, at the end of the day, if you can't get multilateral agreement, countries will go off and do their own thing. Maybe I'm biased, I'm at a multilateral international organization, but, and look, maybe Gabriel's right to be pessimistic about the prospects of multilateral agreement. It doesn't seem to happen in many realms very often. But I guess we are very, very pleased to say that in tax, we actually do have an agreement. Now, there might be differences about whether 15% is enough or not. But at the end of the day, having countries agree that that's the right place to put the floor on tax competition, I think is going to remove some of those perverse consequences that flow from unilateral action. And look, we saw unilateral action from countries like France and the UK when it came to digital services taxes. And then that led to trade retaliation from the United States and then counter retaliation from the EU. No one wins when you go down that spiraling path of tax and trade disputes. So to the extent that you can develop international agreements around some of these principles, I think that's always a better proposition than not achieving that. I think at the end of the day, the proof will be in the pudding. There's still more work to be done. Tasha, you asked the question about how things are progressing. I think on Pillar 2, the detailed technical work has advanced very, very quickly. And we have model rules, we have commentary out there. And now it will come down to a question of implementation. And I think there's a little bit of a debate going on at the moment as to who will move first. And the EU, with its draft directive, has got ever so close to agreeing on that directive. And first it was Poland that was holding out, and then Poland came on board and Hungary's holding out. you know, I don't want to make predictions about what happens in the EU, but certainly many people closer to that discussion than me have some degree of confidence that they're going to get there. And my personal view is, you have a look around the world, you see the UK has been consulting on specific proposals. You've got countries like Switzerland, you've got Singapore, you've got Canada, a number of countries already out there, you know, consulting around what they will implement. I think that you only need one country or grouping to move in a significant way, and I think it's going to be like a domino effect. And that's because the nature of the way these rules operate means that, you know, once someone moves, you really, you know, you're going to miss out if you're not a part of putting that floor in place. So, you know, I'm still optimistic that that we are going to make that progress, but of course, time will tell. And there's a lot of people here at the OECD and in all of the participating countries trying to make that happen.
Great. So I'd like to hear Gabriel respond to the point that you made about the sales taxes or a consumption tax versus, or if that is what his proposal involves. Let me also throw out one more audience question from Damien, who asks, wouldn't a unilateral overseas tax measure like the one Professor Zucman discussed help catalyze multinational agreement and continue to raise the floor of global tax minima?
Yeah, I think that's a very important question, and I think yes, indeed. You know, I think obviously the objective should be international agreements, and I think international cooperation is extremely important. And the question is, how do you get there? And now, you know, historically, it seems that the way to get to ambitious unilateral, the way to get to ambitious global agreements or to create new ambitious forms of international cooperation, often it starts with unilateral action. The best example of this is what happened with the automatic exchange of bank information, you know, the common reporting standard, which is now this multilateral framework for the exchange of bank information. And where does it come from? You know, initially it comes from essentially the US in 2010, you know, unilaterally, you know, basically telling Swiss bankers, look, you have to send us information about the accounts of US customers, otherwise you face, you know, penalties, you know, we will withhold taxes on dividends and interest paid by the US to Switzerland. This was purely unilateral, and, you know, under the threat of these penalties, Swiss banks agreed to cooperate with US authorities. Other financial institutions and offshore financial centers agreed to cooperate with the US. And then, you know, other OECD countries and in the European Union said, look, you know, you're sending data to the US. You've told us for decades that it would be impossible, bank secrecy, blah, 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 but now you're doing it. So you have to do it with us as well. And so you can see how what initially was an ambitious unilateral move by one country led to the creation of a new form of international cooperation that was deemed utopian 10 or 15 years ago. So that's one approach, and historically it's worked, I think, quite well. Another approach is to say we have to start from a truly global, you know, agreement with 138 countries and territories. If this is the starting point, the problem is that it gives over, you know, disproportionate influence and power to certain jurisdictions that have a strong interest in maintaining the status quo. You have to realize that today, the countries that collect the most corporate tax revenues relative to the size of their economy are very low tax countries, you know, are tax haven countries. So they benefit a lot just from, you know, in terms of just tax revenues collected, they benefit a lot from tax competition. So if you insist on the agreement on bringing all those countries on board, then, you know, basically, you know, you constrain yourself to not very ambitious agreements with low tax rates like 15%, big exemptions like the substance carve-outs. So that's why we share the same goals with David, you know, international, inclusive, global, ambitious agreements. But I think we somewhat disagree on, you know, what's the most promising way to get there. I think unilateral actions or multilateral actions by some coalitions or some groups of countries are the most powerful way to get to that objective.
Thank you so much, everyone. I'm afraid we're at time, so we're going to have to cut off there, even though I think we're just getting started on the debate and the discussion. So thank you so much, and it was wonderful to hear all of your very interesting and fruitful ideas.
Thank you.
Thank you.